Today we are talking about a short covering call. It's a simple option strategy as an earnings trade. When the implied volatility is high and being slightly bullish, why not trying this strategy for a great return? So have fun. Currently, there are a lot of earnings on stocks, of tech stocks like AMD, Amazon, and I have tried now on AMD a kind of short call covered. As you can see, you select the strategy, you go on the trade, and you select just this one. Now, this is quite interesting because it's a kind of transaction that you are buying the stock, 100 stocks, and selling at the same time whatever at the money call and get the premium. Why I do that is just at the earnings, just prior to the earnings, just the volatility is really nice and high. And then I said to myself, okay, let's do this kind of combination in a way that you buy and sell at the same time. And obviously, what is so incredible is you get a kind of debit, which is nothing else than the actual price minus the premium received of the call. So actually you pay this price, and out of this price you pay $1 of commission. So this is incredible when you think that of the whole transaction of maybe here now $10,685, you would pay $1 of commission, and this is just one way. On the selling you would not pay anything. So let's see how it goes. So as you can see on the trade on the 1st of August, I bought these 100 calls at 113.61 and I sold at the same time a call at 4.41. So this is the initial. So in other words, my account has been debited with 109.20, or let's say $10,920. Again, my expectation on the 2nd of August for the earnings were um, that it's bullish. So actually the stock market actually has this expectation. We had nice earnings, but I can right here of the feature downgrade. What happened is the stock was at 119.49, and till to the opening it opens at 109.35. So in other words, the trade would be fine, but because of maybe external factors like the Fitch downgrade, the stock went down. And you can see that here that actually that was the initial here, as you see what have been done, and the stock went down to 109.35. So in other words, I was waiting one more day, and on the 3rd of August I was selling the 100 stocks at 110.70. I bought the one call back at 69. So whatever I lose on the call on the stock price, I win on the call, because remember the call I sold at 441 and the call was just 69. So the whole transaction gave me a profit of $81 with $1 commission. As you can see here, this is the trade, and this is the only commission I have here besides the exchange fee. But just to show you this idea. So here I did another thing on Pinterest. The same thing. I had a high IVR and a high implied volatility. I expected that pins will bring some nice results, that it would be slightly positive. Always that what happened again is that the whole stock market was weak. It's a bit wrong here. So I bought 100 at 28.41, sold the call at 181, sorry. I closed the position on 23, that on the 2nd of August. So I sold at 27.64, which you see is again slightly and under the price I bought, but because I get the premium out of the call, I sold at 181, I bought at 141, I get a profit of 63, and here again just $1 commission. Covering call was that one of Amazon. Here again my expectation was slightly positive, and actually the stock went very strong. I mean, he came at we come up from I think 128 to 140. So this one was a real full of success in a way that I cannot earn more the maximum. I can only earn the maximum, which is the premium of the call. So you see, I did this transaction here on the 3rd of August, just 6 minutes prior to closing. And the next day, I just closed his position with a nice profit of $475 with $1 commission. I did another transaction even on Palantir, which you can see here. So I bought 100 pieces at 70.74. I sold one call 17.5 at 139. I could have sold this position with a small profit, but I keep holding on. And now, if you see, the stock market in general went down. So the price of Palantir is around 15.5, which would result in a small loss. But since the position is very small, I keep holding on. And what I'm doing now, having this position, I just keep selling calls by every 1 week, 2 weeks, or even monthly against the 100 stocks. So this would be the other possibility. In a moment, you cannot realize or sell, let's say, the stock with these call options. You just wait till the call option expires worthless, and then you just do a weekly call option like August 18 or September 15, and just sell the strike of 17.5, and you always will get a premium out of it. So to summarize, this short covering option strategy is an investing tool for some investors expecting a slightly bullish or sideways direction of the stock. This is nice when the stock goes a bit up. The time value is working for you since you are selling a call option. That is important too. You just do that when the implied volatility ranking IVR is high and the essential tool to sell in a call option. The call option, for me, it's important that you sell let's say, the strike of the call option at the current stock price, because you want to earn most of this extrinsic value. So, as I said in the example of Amazon, for instance, I sold the call option at the current price. Let's say the current price was, I think, 129, so I sold a call 129. So if the stock goes down that I had in Palantir, the call option will expire worthless, thus giving the possibility to sell again new call option with different maturities. So that I'm doing now in Palantir is that the current call option expire worthless, and now I'm selling every week a new call option with a strike 17.5 till the moment that I will get exercised when the stock itself is going over 17.5. The commission of the trade combination selling a call, buying the underlying is an incredible $1. As you have seen, you don't just pay $1 for the whole transaction and only one side. So if you sell, or let's say if you break even the call and the underlying, you pay only on one side. Use again this short covering call in trades, which I'm quite convinced that the company will bring a bullish trade, I mean a bullish earning. You can see that sometimes when you check a call and the put option, let's say as a short strangle or short strangle, if the call has a higher premium in the put, then actually the expectation, like we had in Amazon, is higher. So that is why I would see that I get such a nice option premium, call option premium, that I sell the premium against the underlying. And then I would do it. Obviously, we always have the risk that it will not work every time, like it was the case in Palantir. But still, then the risk is quite nice as you bring the break even of the stock low, let's say of the premium received. So in other words, you don't buy the stock at the current price, you buy the stock actually minus the option received by the call option. Okay, that's all for the moment. I will follow up with some other strategies. I hope you enjoyed, and till next time, bye bye.